A busy Wednesday here in the U.S. It started with economic data, a Treasury refunding announcement, and it's going to get busier once we get to the closing bells, earnings out of Microsoft and Meta. But of course, we kick you off to the close with the big decision of the day. No decision from the Fed, and quite frankly, no real clarity as to where we go next. Romaine Bostic here with Sonali Basak. This is the close.
And let's take a look at where markets are standing right now, Romaine. You are seeing the S&P 500 bouncing right around its session lows. Remember, we were higher earlier in the day, but in the last hour and a half, we have seriously turned around. The S&P 500 now down 0.3%. The NASDAQ 100 trying to squeak back into the green. Not a love for those tech-heavy stocks that we're looking for to report after the bell today. The two-year yield actually now back up by almost 7 basis points. It's near 394 in the wake of that Fed meeting, and the chances for that September rate cut are lower than they were before. Copper futures still down around 19.6%. Remember, the administration, President Trump, now looking to roll back those tariffs on refined copper products and retaining them to those ones that are semi-finished products alone. So the copper really
another big story here on the day.
Taking a bite out.
Yeah, absolutely. Another big story here on the day that we are going to dive a little bit deeper into. But we start, of course, with the FOMC meeting today. A 9-2 decision, 2 dissents here on the day to hold the federal funds rate at 4.25 to 4.5. Chair Jay Powell at the press conference today.
At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Despite elevated uncertainty, the economy is in a solid position. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get.
Jay Powell moments ago at the podium in Washington. Around the desk here in Studio 2 in New York is Rebecca Patterson, former chief investment strategist at Bridgewater Associates. And it seems that the real parlor game right now isn't so much about what the Fed just did today, but whether we can actually anticipate rate cuts at one of the next 3 meetings this year.
Yeah, I mean, the initial market reaction certainly has been a little more hawkish, a little less excitement about a possible September ease. You saw the 2-year yield higher, you saw the dollar higher, and as Sonali just said, we saw stocks a little lower. And I think that adds up with his press conference. You know, he's saying the labor market right now, because yes, less demand for labor, but also less supply, so unemployment rate is steady. So they can leave that alone. The focus is inflation, and they still believe there's a chance that tariffs come through more in the next 2 readings they're going to get on inflation before their September meeting.
Are they being too skittish about the impact, the inflationary impact of tariffs?
I don't think so. I mean, we did see core goods, a lot of core goods going up in the last CPI report, and the tariffs really are just starting to have an effect. Remember, we had a lot of pauses. Those pauses are now being lifted, so we're going to see that. And we are hearing from a lot of companies during this earnings season that they have just raised rates or they're about to raise rates. So I would guess companies still absorb some of it, but consumers get the rest.
At what point do you think this becomes a bigger problem moving forward? Because we were talking to Abby Joseph Cohen a little earlier today. She says you can see that effective tariff rate around 18%. That is a lot higher than a lot of investors were expecting.
I agree with you. I totally agree with you. And another reason we didn't feel it earlier this year is because companies had built up inventories. And a lot of those inventories have now been wound down, so they don't have that hoard of still lower cost goods to pass through. So I do think what Abby said is probably directionally right.
Is the taco trade petering out? The president announced these rollbacks right into this Fed meeting, yet you're watching the macro overtake the market. Can the market stop then counting on him to roll back those tariff rates?
You know,
to boost the market.
I kind of roll my eyes a bit when I hear analysts say, oh, we have clarity now, we have clarity. And I'm thinking, really? I'd love to see it. I mean, we have potential secondary tariffs or sanctions on India or China, depending on what Russia does within the next 2 weeks. You know, yes, he stepped back on the copper tariff for part of it, but part of the copper imports are still 50%. We have Section 232 tariffs coming on a lot of different goods in the coming weeks and months. Brazil's going to get 50%. So, and we still don't know what we're going to have for Korea, for example. There's some big countries out there, and China, of course. So I don't think we're done with the uncertainty, and I do think that flows through to inflation expectations and confidence, which is going to affect economic growth.
We should just point out for our viewers, speaking of Korea, the president speaking, saying that, quote, on South Korea, he's saying that they have an offer to buy down to a 25% tariff, and says, according to Trump, that South Korea is interested in that offer, and the U.S. is too, and that they're going to be meeting with the Korean delegation later today. So who knows what that means?
Yes.
But, you know, it is the president, so we bring you whatever he says. But it gets to this idea. I'm glad you brought up this idea of clarity or uncertainty, and the idea that there is a certain pocket of this market that sees a little bit more certainty. And is this enough? I mean, I know it's not full clarity. I know it's still foggy out there.
Yep.
But for a market that was pricing in the absolute worst case scenarios at the beginning of April, to go to where it is today, which is basically effectively a record high for the major indices.
Right.
What does that tell you?
So I'm going to meet you guys in the middle.
Yeah.
So yes, it's less bad than it might have been on Liberation Day at the beginning of April. But to your point, we're looking at an average effective tariff rate of around 18%. That's a big tax on some combination of corporations and consumers that we're just starting to see take effect.
When we're talking about the impact on the macro moving forward, how long can this go on before taking a real bite out of the job market, out of consumers? Because we've seen all of that hold up fairly steady until now.
Yeah, it's consumers are still spending, as Jay Powell mentioned during his press conference, and as long as they're still spending, companies are going to be reluctant to shed too much of their labor force, right?
Yeah.
They're still scarred from the hiring difficulties they had after the pandemic. So there's some labor hoarding going on. But if the consumer gets more cautious as they see prices rise, companies are going to feel more pressure to lay off workers. And then you get that negative feedback loop. Then the Fed's cutting. But I don't think we're there yet.
Real quickly, less than a minute, but with regards to the earnings that we've gotten so far, what have you taken away from the commentary on tariffs and the economy?
I mean, the banks were clearly, the consumer is still fine, at least until today. We're seeing a lot of companies saying we are either thinking of raising prices or we are raising prices. And I think still a lot of uncertainty about the tariff impact and some hits. I mean, you're seeing automakers, for example, talking about $4 or $5 billion hits this year.
Yeah.
That's not small.
Yeah, we should point out, we're going to have to say goodbye to Rebecca Patterson, former chief investment strategist at Bridgewater Associates. And on her final point there, Shonali, we should point out we are expecting to get earnings out of Ford after the bell, among 24 companies expected to report, including Microsoft and Meta.
Speaking of interest rate sensitive sectors and tariff sensitive sectors, we have a lot going on after the bell. We'll see if those AI companies are immune at all to some of the pains we've been seeing in the market today.
All right, another down day for the S&P 500. Fractional losses to be sure. The NASDAQ holding in the green. Fractional gains to be sure. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Shonali Bassick taking you through to that closing bell with a global simulcast. It started. Carol Masser, Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube here on Fed Day, here on GDP Day, here on Treasury Refunding Day, here on Earnings Day. Carol, who you got?
Oh, my God. I mean, so much coming at us. I just want to say, in terms of takeaway from Fed Chair Jay Powell, I mean, he gave investors so much to think about. But what I really thought was interesting, he said, we're in a special situation with two-sided risks to goals. So he's looking at that dual mandate, saying that there are risks to both in the end. So he's going to be continuing to watch all the data that comes at him and the members of the FOMC before that next September meeting.
Yeah, that September meeting, though, a cut, not a done deal at this point. The odds of that moved down substantially, despite the fact that President Trump, just ahead of that press conference, put a message out on Truth Social that said, I hear the Fed will cut rates in September.
Oh, where did he hear that?
I don't know. He said, I hear they're going to do it in September, not today. President Donald Trump said at a bill signing ceremony at the White House.
The market's not listening, though.
They're not.
You look at the futures pricing, and they're actually pricing less of a chance for that September rate cut than they were just yesterday. And so where he's hearing it from, the market is listening to the people that did not dissent.
Good point, Shanali. You look at WIRP on the Bloomberg terminal, you can see the change in expectations. You don't even have to go there. Just take a look at the 2-year yield, higher by 7 basis points on the day. You're seeing strength in the dollar. The VIX elevated here on the day, and a mixed bag for equity markets, with the biggest pain coming in the cyclical and economically exposed sectors. Dow Transports finishing out the day down 3% here on the day. You'll take a look at the KBW Bank Index, the KRX, and some of those other cyclical sectors, and you'll also see similar declines. As for the benchmark index, the S&P 500 down for a second straight day, down about 0.1%, and the S&P, the Nasdaq, excuse me, Carol, up about 0.1% on the day. Earnings crossing the wire, Qualcomm.
Indeed, Qualcomm. And let's go right to the outlook. Fourth quarter revenue, they're looking, folks, for $10.3 billion to $11.1 billion. That's above what the street is expecting, at least on the higher end. $10.61 billion is what the street's expecting. Fourth quarter adjusted EPS, more for the outlook, $2.75 to $2.95. The estimate on the street is for $2.84. And again, seeing, let's go back to the past quarter. Third quarter adjusted EPS, $2.77. That's better by a nickel in terms of what the street was expecting. And third quarter adjusted revenue of $10.37 billion, pretty much in line with what the street was expecting, Tim. $10.33 billion. Stock little change, just down about 0.6% here in the aftermarket.
Yeah, pulling up that earnings release here. The company, actually, it's not even up yet on their investor relations website. That's how early these numbers actually came out. Worth repeating, the fourth quarter revenue outlook, though, does seem to be what is moving the stock in the after hours, just ever so slightly bouncing between gains and losses, down about 0.5 percentage point. The company says the company says CapEx at $785 million. The company also said third quarter adjusted revenue coming in just above estimates at $10.37 billion. Once again, fourth quarter revenue, that outlook, $10.3 billion to $11.1 billion. The estimate was for $10.61 billion.
Yeah, the promising sign in there, Tim, would be that there are signs of resilience and growth in the smartphone sector. And of course, we'll be waiting for a read through on that when you're thinking about these large technology giants, the consumer exposure matters here a little bit. The high-end phones, though, are where they're doing even better. And so the question about that K-shaped recovery throughout the course of this earnings season resumes.
Yeah, and it's kind of interesting, too. We should point out we're also expecting to get earnings out of ARM, the UK chip maker. And of course, we're waiting on some of the big heavyweights in the indexes. That includes Microsoft, Meta, also expecting Ford, Albemarle, Lam Research, eBay, and Western Digital, amongst others, guys.
Yeah, and it's just a reminder that not all chip companies are the same. So Qualcomm may be giving a little bit of a better forecast, but we've been getting from Texas Instruments, Intel, which also gave more cautious outlook. So it's just a reminder, you got to take a look at each of these companies and what their fundamentals are and really what markets they play into.
Ford reporting in just a couple of minutes. We've got an interview with the company's CEO coming up in just about a half hour. We're also expecting, of course, Meta Platforms a little later, too.
Yeah, I've got to say, just to kind of get back to what we were talking about with Qualcomm, remember, this is a stock that's only been up 3.5% this year. So there's a lot of room here for the upside if investors choose to read it that way, but you're looking at it turn further negative here, down about 3%.
All right, Microsoft earnings are crossing the wire right now. So too is ARM. Let's start with Microsoft. The initial knee-jerk reaction to the upside, as the company says, revenue in the most recent quarter, $76.44 billion, a beat. The street was looking for $73.9 billion. Intelligent cloud revenue also coming in slightly above estimates at $29.88 billion. Azure and other cloud revenue, ex-FX, up about 39% in the quarter. The street was looking for a gain of about 34% in the quarter. I just want to point out one other quick thing. I know it's a much smaller business, but when it comes to the productivity and business revenue here, you did actually see a beat there as well, $33 billion. And on the personal computing side, Tim, Carol, $13.5 billion. Street was looking for 12.7.
I got to say, I was curious about in terms of valuations for this one because Microsoft, well, fascinating to watch the trade here because it's bouncing around. I mean, this is a stock that's up 22% year to date, and we are seeing off of these numbers initially a gain of about 5%. So investors definitely liking what they got. I've got to say that Azure and other cloud revenue, maybe that's what's catching their attention, up almost 40%. They're up 39%, and that is easily beating the estimate of 34.2%.
Yeah, Satya Nadella, chairman and CEO of Microsoft, saying, quote, "Cloud and AI is the driving force of business transformation across every industry and sector. We're innovating across the tech stack to help customers adapt and grow in this new era. In this year, Azure surpassed $75 billion in revenue, up 34%, driven by growth across all workloads.
And even beyond that, I'm looking at CapEx numbers as well that came in for the quarter at least lower than expected. So that outperformance comes on the heels of not overspending either. I know a lot of investors are out there looking to make sure that they're getting a return on their buck. And you are seeing Microsoft just surging after this report because, to your point, Carol, Azure was really a big part of what investors were looking for and making sure that more and more of that revenue was being driven by those AI initiatives.
And I guess I would say when it comes to AI, you got to think about the Microsoft relationship with ChatGPT. You know, they are kind of the king, queen, if you will, in terms of what has set us going in terms of AI.
Yeah.
We've got Ford crossing the Bloomberg
Yeah,
terminal.
let's go to Ford for a second. We'll get back to Microsoft. Those earnings crossing the wire. Remember, the company had removed its guidance a quarter ago. It is now reinstating that guidance for the full year, and it does appear that guidance is lower than the one it gave before, saying that it expects earnings before interest and taxes, so EBIT on an adjusted basis, $6.5 to $7.5 billion. The low end of that range is slightly below the average of street estimates, which was for $6.84 billion. Also interesting, the company is trying to quantify the impact from tariffs, saying they see a tariff headwind of about $2 billion. That's up from a previous guidance of about $1.5 billion, though they did point out that that number could be as high as $3 billion, though they expect about $1 billion in mitigation, if you will. Not quite sure what that means. That brings it back down to $2 billion.
Well, speaking of high numbers, Meta shares surging in the after hours, up about 3.6%. The company sees third quarter revenue at $47.5 billion to $50 billion. The estimate was for $46.2 billion. The company sees total revenue for the year to be in the range of $47.5 to $50 billion. It sees expenses to be $114 billion to $118 billion. So expenses were expected to be $113 to $118 billion. Second quarter revenue, once again, beating estimates. Second quarter EPS coming in at $7.14. That's massively above expectations of $5.89. Second quarter revenue expected to be at $44.83 billion. $47.52 billion is the print. Shares surging in the after hours, up 6.7% and climbing.
Yeah, and that's after Meta has been quite an outperformer. It's up about 19% year to date. Hey, let's go to some commentary and context. Company saying they expect third quarter 2025 total revenue to be in the range of $47.5 to $50.5 billion. And they say while we are not providing an outlook for the fourth quarter revenue, we would expect our year-over-year growth rate in the fourth quarter of 2025 to be slower than the third quarter as we lap a period of stronger growth in the fourth quarter of 2024. So they expect full year 2025 total expenses to be in the range of $114 to $118 billion. So that's narrowed from their prior outlook of $113 to $118 billion and reflecting a growth rate of 20 to 24% year over year, and currently expect 2025 CapEx, including principal payments on finance leases, to be in the range of $66 to $72 billion, narrowed from their prior outlook of $64 to $72 billion, and up approximately $30 billion year over year at the midpoint.
I also want to look at ARM here as well because they're forecasting profit lower than expected. They're ramping up spending here. You do see shares down more than 5.7% after the market, after saying that fiscal second quarter earnings will be 29 cents to 37 cents a share. Analysts had seen 35 cents on average. So there you go, softer profit expectations there.
All right, real quickly, eBay, those shares higher in the after-hours trade guidance for the third quarter of $2.69 to $2.74 billion, above street estimates on both the low and the high end of the range. For the most recent quarter, the company did beat on both the top and bottom line, revenue growing 6%, Tim, to $2.73 billion.
All right, shares of Robinhood up 4% in the after hours. The company's not giving a 2025 outlook for operating expenses, but second quarter adjusted EBITDA was a big beat, coming in at $549 million. Second quarter net revenue also beat at $989 million. Once again, shares higher by about 4.5%.
Just got to say, Meta on our way out, up more than 8% here in the aftermarket. Microsoft up more than 6%. I'm looking at E-mini futures, S&P. They're up about 0.3% here in the aftermarket. All right, guys, that's a wrap. A lot of earnings, a very busy Wednesday. That's going to do it for our cross-platform radio, TV, YouTube, Bloomberg Originals. Shanali and Romaine, of course, finishing up there on TV. Tim and me here on Bloomberg Business Week Daily. And we will see you again, same time, same place tomorrow.
Our coverage continues with a look at the two biggest gainers in the after-hours trade, and that is Microsoft and Meta platforms. Microsoft up 6%, Meta up 8%, a beat on the top and bottom line, but more importantly, a commitment, a recommitment, if you will, to that CapEx spend. Meta saying that it sees full-year CapEx in a range of 66 to 72 billion. That's a nudge higher on the lower end of that range. Microsoft saying its CapEx spend for the quarter, including leases, should be about 24.2 to 23.17 billion. That's for the quarter that just passed. We have to wait for the conference call to get the guidance out of Microsoft. We don't have to wait for Caroline Hyde. She is the co-host of Bloomberg Tech, and she joins us around the desk here to help break down these earnings. Where do you want to start, Microsoft or Meta?
I just think for both of them, the context, these are trillion-dollar companies, and they're managing to post, for Meta, more than 20% growth in terms of revenue quarter on quarter, much ahead of expectations, and signaling it's going to be 25% potentially for the next quarter. That Microsoft's still managing to build up 18% growth. Isn't that extraordinary? We have companies that valuable growing at that rate of run rate, and the fact that for Microsoft, a nuance here, we're actually getting an Azure number for the first time. You read that out, that $75 billion. They've never split that out for us. We can finally really see how the bang in CapEx buck is happening for generative AI.
So how much room does that give them to spend more? Because if you're seeing Meta post these numbers while also committing to even the higher end of their range, upping the low end of the range for CapEx spend, does it give these two companies just a boatload of firepower to spend more money on AI?
And particularly for Meta, where they've shown that it helps their product. The generative AI is making their advertising more easy to use. Marketeers want to lean into it. No wonder you're seeing the pricing of those ads going up by about 9%. They're able to charge more broadly. And they're also trying to articulate, what does superintelligence labs mean for them? Yes, they've been spending in CapEx, but boy, have they been spending big on talent. We've heard about the $200 million pay packages, the amount they spent on Scale AI. But all of this is about making it more personable. You're going to have a superintelligence helper for your personal reasons. That's what Mark Zuckerberg's trying to get across here. And it helps his business because he's trying to sort of throw shade on some of the, well, enterprise needs that we've seen. And look, you're not going to be using your software app so much. You're going to be using my app more, and therefore the vindication in the CapEx comes through.
All right.
You don't seem convinced?
Well, I mean, some of us don't necessarily want a super intelligent assistant, but you know, but I get it. But I get it. No.
I could use a few.
You know, I would take an assistant.
Caroline, thank you so very much. We're looking forward to the rest of your coverage. That is Caroline Hyde, co-host of Bloomberg Technology. We're going to stick with those tech results. We are joined now by Daniel Newman. He is CEO at Futurum, a technology research and advisory firm, who says that Microsoft is a cash machine and an AI killer play. Now, Microsoft versus Meta. I'm going to make you choose your darling here because they're both coming out strong after hours.
Yeah, Microsoft threw a curveball on this one because if you'd asked me 1 hour ago, I would have said Meta. I was certain that Microsoft was going to do the business, but I think Meta has done a better job of applying AI to its business than any other company. But that 39%, $75 billion number, and this is without even really having its own infrastructure yet and having its own LLM, still in this odd OpenAI relationship. So I took a pause, Sonali, but I'm going to actually still say Meta. But Microsoft really did the business as I expected they would.
I do have one more question about Microsoft, though, because to the point that Caroline was making about knowing just how much money Azure is making, what is the cash generating potential there now that we know a little bit more how much it's putting up?
Well, we saw that growth rate. And one of the things I was looking for here was, can they accelerate at a rate that's faster than Google? Because I think Google's been one of the big winners of this kind of AI cloud shift. It was all about AWS. And tomorrow they'll show their numbers. This is going to put AWS under a lot of pressure if it does another sub 20% result for the business. So Microsoft is clearly showing that without its own chips, which is something Google, AWS, and others have invested in, Microsoft's just getting started, without having its own LLMs to scale, meaning they haven't invested the way Google, AWS, OpenAI, and others have, that they have been able to transform their enterprise business into an absolute juggernaut. At this growth rate, you would say that they can compound this, they can continue to invest, build on CapEx. My only concern is the overdependence, and this is a big risk because I really love NVIDIA, but it's that overdependence on NVIDIA where you see other companies doing more to vertically integrate, which could help margins down the line.
Well, I am curious, and I mean, let's just go to Meta for a second, because I mean, they're spending just as much as Microsoft, more or less, and some would say, at least in theory, they maybe are spending it in a more tactical way. When you look at the amount of money that Meta is spending, not just on the actual CapEx itself, but some of these reports of these outsized pay packages they're doing to lure talent there, are you comfortable with that as an investor?
It took me some time to get comfortable. I use the analogy of building the world's best team. It doesn't matter if it was the New York Yankees or you're building Manchester City. Sometimes you have to buy the best talent to win the league. Meta obviously understands that this is multiple trillions of dollars of market cap at play, and it saw that it sort of hit that rate limit. I was always very bullish on Meta and its ability to achieve and build open source models, but clearly with Behemoth, it started to hit some ceilings, and it needed to go out and invest. And these $100 million, $200 million pay packages, they may seem absurd, but if Mark Zuckerberg is able to win, and this is a combination of winning on stickiness in the platform and all the revenue benefit it's creating for its own tools, but also winning in open source and being the world's leader in AI, there is hundreds of billions, if not $1 trillion of immediate market cap gains that could come in the next year. We saw how quickly NVIDIA went from 3 to 4. It's entirely possible Meta sees it go from 1.7, 1.8 plus to 2.5, 3 trillion just by convincing the market it's the best AI play.
Yeah, we're watching Meta shares right now in the after-hours trade hit highs in that after-hours session, up more than 10%. But I am curious. I mean, we're seeing Microsoft rally. We're seeing Meta rally because of all the money they're spending on the future. What about some of the chip stocks? We just got reports out of Qualcomm as well as ARM. ARM making it very clear that it does plan to ramp up spending on R&D to sort of chase after the AI trade. Shares are down on that. And Qualcomm, I'm not quite sure what they're doing, but of course they've been trying to make a little bit of a pivot to become less reliant on the smartphone universe. How do both of these companies stack up in your view?
Yeah, Romain, I had a chance to speak to Renee Haas, and it's clear that that company is going to move into something more AI-centric solutions and IP. And of course, it's got the CPU and it's connected to, say, Grace and Grace Blackwell, or everybody knows that it's a very important component, but there's a huge TAM and expansion there. So my take on why their EPS went down, and this was sort of reiterated in my conversation with Renee, was it was related to the investment the company is making to expand the TAM and continue to grow in areas where it has higher margin and more opportunities into the future. So I'm still very optimistic about ARM. We rate the company very highly in our Futurum AI 15, which is basically the biggest AI companies outside of the Mag 7. We have them in our top 5. So we see a lot of potential there. Qualcomm sits in our top 15 as well, because we do believe that the handsets, the devices, the CPUs, and of course, physical AI. So Qualcomm's done really well in autonomy, in ADAS, and they have a pretty significant IoT play. And that's where I really like them for growth. But they've had to grow against this headwind of Apple steering its business away. And of course, as it's gone away, we're actually seeing growth accelerate. I think they showed a number of like 15% for this quarter, which is pretty encouraging for the business. But it doesn't trade like a company that has a lot of growth potential. And that's why we like it. We think it's being missed. If they can enter physical AI, robots, use their XR technology, their handset technology, plus their ADAS technology to actually fuel maybe lower cost robots than, say, what Tesla is going to bring to market, I think that could be a boot. It's a little further out there. But overall, it's been a steady business. They're holding their end. And of course, their business is right within the range, if not a little bit above. So as an investor, undervalued, pretty solid play.
Dan Newman, got to leave it there, CEO over at Futurum, a breakdown of some of the earnings that we've gotten out of the big tech names, the Qualcomms, the ARMs, the Microsoft, and of course the Metas. Meta's the star of the show, up more than 10% after going all in on AI, allowing marketers to use the technology for advertisements, all in a bid to make it cheaper and simpler for brands. Mark Douglas joins us right now. He's the CEO of Mountain, one of the premier ad tech platforms out there. And we're always remiss not to point out that for all the talk about AI and the metaverse and all this, Meta at its core is an advertising company, and that advertising is still the juggernaut, up 21%, $46 billion in ad revenue alone, Mark.
Yeah, I mean, I think that points to Meta's dominance in performance advertising, obviously for social. And they have just, I think it's now 12 straight quarters. They've just been growing significantly. Their investment in AI, I think, is really going to pay off for them, because it's going to continue to expand that SMB market that is so much of their revenue, by making it really easy for those smaller advertisers to get higher and higher quality creative. So I think that's the thing to look towards for the future.
With regards to the rollout of AI, some of those AI tools and other features, how does that sort of affect Meta's costs with regards to ads? And the idea that does it help ad impressions? Will that be better? Does it actually drive down the cost, or excuse me, change the cost price per ad? Does it change discovery? Anything?
Well, they can raise how much they charge, but the way to think of it is that those small advertisers are looking for customers. And creative matters, right? So Meta, obviously, with Instagram and other properties, they have this incredible conduit into the consumer. And then they have like incredible data or use of data, I should say, in order to figure out which consumer, kind of is going to want one. It's so good that, a lot of people say, I feel like Instagram is listening to my conversations, which is not happening. But that's how good that targeting layer is. If you then add in better quality creative, for that brand to tell its story, that's also going to contribute to better performance and ultimately more revenue. So I think, Meta has a lot of room to grow as as the creative gets better. They'll literally expand the number of advertisers and expand the performance on the existing advertisers. Both will lead to more growth.
Mark, you know that I do all my shopping, all my stress shopping on Instagram. So you're talking to the right person here. Meta has the average price per ad increasing 9% year over year. My question is, who are they crowding out? Because corporate America isn't sitting here flush with cash writ large to be spending on extra marketing dollars. There are still tariff uncertainties. Can we see them squeeze others out very materially at this point and gain much more share?
Well, I obviously, Mound, we're doing performance television, so we're seeing that gain a lot of traction. The TV industry is kind of battling back. We're a part of that. So I don't necessarily think, but for the advertiser, what they want to diversify. They want to be investing in search, social, television, email marketing, for retention marketing. So it's not a zero-sum game. All can grow together. And what's happening here is Meta is just growing their piece of it and doing it more effectively. So I don't think anyone is losing in that equation. Actually, the customer is the big winner because they're seeing success everywhere they look.
Mark, who's the main competitor at this point when it comes to attracting those extra ad dollars?
I don't really think, sorry, I feel like I'm starting in a response. It's because I don't really think of it that way. So each of these advertisers, when they look to grow, the way they do this is they say, how much of my growth am I going to get from Google? How much am I going to get from Meta? How much am I going to get from Mountain? And they just allocate, if the advertiser is going to grow 30% next year, then the amount they spend with Google, Meta, Mountain, Amazon is going to grow 30% also. So again, no one's kind of getting crowded out. I think in the brand advertising arena where those budgets are more capped, that is an issue. But Meta never worries about brand advertising. They literally yawn when people talk about big brand advertising. They just simply don't care.
So I am curious, Mark, as you kind of work through this earnings season, when we've already heard from Alphabet, obviously another big ad company, they did well. I think what is Amazon? I think it's tomorrow. We're getting a broader picture here of kind of this new cohort, relatively new cohort, I should say, of sort of ad giants here. Are they not at all affected by economic cycles the way that advertisers of decades past would be?
They are, but the opposite of what to expect. So these companies, the big direct response performance leaders, when the economy is going bad, the advertisers tend to spend more money on performance marketing. So the brand advertising market tends to shrink. So those are the agency holding companies, and those tend to suffer. But the performance marketing machines, like the Googles and Metas, they tend to grow. And so to a certain extent, I've seen pictures like illustrating it. They're like recession proof. In recessions, they tend to grow even faster as companies don't want to give up their growth. So they spend even more money on search, social, and these other channels.
Mark, we thank you so much for joining us. On the heels of these results, that is Mark Douglas, Mountain CEO. And Meta CEO Mark Zuckerberg unveiling the company's AI strategy earlier today, writing, quote, Meta's vision is to bring personal superintelligence to everyone. We believe in putting this power in people's hands, distinct from others in the industry who believe superintelligence should be directed centrally towards automating all valuable work. Bloomberg Opinion's Dave Lee covers tech, joins us now. And you actually see a little hint of this, perhaps, if you are optimistic about the acqui-hires of the future. Meta saying that and really hinting here that growth in spending is going to be a prominent feature next year. How much of it goes to acqui-hires towards superintelligence?
Well, look, he's clearly, it seems, still in the process of assembling this incredibly expensive team that he's been putting together over the past weeks and months. I think today's going to be looked at as it's quite a pivotal day for Meta's AI, right? I think we've seen these very, very strong earnings that shows the existing business is cooking on gas, right? Still bringing in the advertising revenue, still growing, believe it or not. There's still people joining Facebook, which, amazes me. At the same time, we had these messages this morning, a video message from Mark Zuckerberg, a sort of manifesto from Mark Zuckerberg, signaling this sort of focus on Meta's strength in AI, which is going to be a more personalized assistant.
The more personal aspect is interesting too, and we've had other manifestos from Zuckerberg, but this one seemed to really hit a nerve because, I mean, he is pointing out something that is a reality, which is there are certain companies in this AI ecosystem that certainly want to more centralize, or at least centralize around them, if you will. What do you see as the potential advantage of a more personalized approach, as Zuckerberg tried to articulate today?
Well, I think it's Zuckerberg looking at what he's got as his own advantage, and right now he's running the biggest social network in the world.
Yeah.
Sam Altman isn't doing that.
No.
Right? Apple isn't doing that.
No.
Google has its own version of personalization from Maps, Gmail, whatever.
Yeah.
But what Mark Zuckerberg has is this wealth of data on people communicating, their friends, their family, their connections. And I think he sees that and thinks, okay, it's time to lean into that and use that intelligence to build an AI that's more personalized, knows a bit more about us than some of those competitors. What I do think it is a departure from the existing strategy, which is to create the big open source model. That's been coming under a lot of criticism, people wondering how he's going to make quite so much money from that. I think it's a bit of a change in direction, but it seems like it's been very well received.
Well, could you argue here that by being open source like that, he is creating a new way for the industry to operate, and therefore maybe, right, he was the one that kind of went out ahead of OpenAI and said open source is the future, wasn't he?
Yes, but I'm not sure he feels quite the same way now, right? I don't think that's been as successful as he thought, and much of the reason for this dramatic sudden hiring, you could even call it a sudden panic on Zuckerberg's part. I need to get all these people in because I'm going to dramatically change my strategy. And one way to convince those people to join, it seems, has been to say this will be a closed source.
We only have about a minute left, but I do want to get your thoughts on Apple's AI strategy or lack thereof. Because, I mean, there's been a lot of criticism, some of it fair. But it also, there's been an argument that maybe Apple's sort of, tortoise approach relative to the hares might actually be a little bit more sensible than, just throwing money at the wall the way we're seeing other companies.
I mean, look, it could be that Tim Cook has saved himself a lot of money here by not going after, this top talent in the same way. Some of Meta's AI team was poached directly from Apple. It seems Apple sort of might have given them a bit more money as an offer, but they didn't take it. They weren't prepared to go above and beyond to keep these people. I think that suggests that Apple is aware that its main strength here is the iPhone. And that's secure for years yet, in my view.
But they need to leverage that, right? I mean, in the same way that Meta is leveraging its sort of legacy ad business to fund whatever the AI future is, why aren't we seeing maybe Apple, Tim Cook, take a little bit more aggressive?
I think in Apple's case, the way to strengthen that position is new hardware as opposed to the AI. I think lacking AI features on the iPhone is a problem, but I think it's one they've got time to solve.
All right, Dave Lee of Bloomberg Opinion, Meta and Microsoft, two of the big gainers in the after-hours trade. To the downside, we're keeping an eye on Ford. Those shares down 2% after the company reinstated its forecast and reinstated it below where it was before. A conversation with the CEO, Jim Farley, up next. We want to welcome our Bloomberg TV and radio audiences back to our coverage. A closer look at earnings out of Ford. They crossed the wire just a while ago. Second quarter results showing adjusted EBIT coming in at about $2.1 billion, revenue at $50 billion. But more importantly, the company reinstating the guidance that it had pulled earlier, saying that it sees adjusted profit for the year of $6.5 to $7.5 billion, the low end of that range, slightly below the average of analyst estimates. Joining us right now here in Studio 2 is Matt Miller. He is the co-host of Open Interest, and he joins us for a very special interview with the CEO of Ford, Jim Farley. Matt.
Thanks very much, Romaine. Jim, thanks for joining us. I want to ask first about how you're offsetting these tariffs. I was on a call with Sherry House, your CFO, earlier. She said the hit to growth would be about $3 billion this year from tariffs, but you're able to recover about a third of that. How are you doing that? Is it through pricing? Are you able to get it out of suppliers? What are you doing to get that back?
It's all of it, but the biggest strength for us is Ford Pro, our commercial business. And it's not just vehicles, it's also software and our parts business on Pro. That's where the strength of our business is, and that's why we increased our guidance net of the tariffs by about $500 million. It's Pro. We expect flat pricing for the rest of the year. So it's really Pro that's driving our results.
Hopefully investors know the story already, Jim, but I don't think everyone understands the breadth of services you offer through Ford Pro and the kind of growth you're seeing. You've added $2 billion to revenue year over year, well over $3 billion to revenue quarter over quarter. And I was looking at the valuations of some of the competing businesses like Ryder, Geotab, Samsara. They all blow away your valuation. I feel like Ford Pro would get a much higher multiple if it was trading outside of the legacy automaker. Have you thought about spinning that off?
We have, but we don't want to do that. That's why we broke it out as a separate segment, Matt, so everyone could see the profitability, double digits margins again, really strong results. We have almost 800,000 monthly subscribers for our software, as you said. We're beating now the third-party software providers because we can control the vehicle speed. We can control access to the vehicle now. Third-party can't do that. We also have a very strong parts business. Our dealers have invested $2 billion in large repair facilities. We've never really been in that business in a big time to compete with third party. Now we are. And almost 20% of the profits now for Pro are non-vehicle. So it's a great ecosystem. It's something our competitors do not have. That's why we broke it out separately so all the investors can value just that.
It certainly was the bright spot. I am curious, Jim, about the strategy going forward with regards to the electric vehicle business. When we talk about the commitment to new models and, more importantly, commitment to the infrastructure to support that, what's the plan?
Well, that's a great question. First of all, Ford is number 3 in hybrids, but we're number 1 in truck hybrids. So we're going to expand our hybrid offering across our internal combustion engine lineup, and that's going to really distinguish us. But we're starting to see different kinds of hybrids that customers are excited about. E-revs, which go about 100 miles, all electric, but then you could take a 700-mile trip once in a while. Those look really promising for a 3-row crossover like Explorer or some of our trucks. Our EV strategy, we've been number 2 to Tesla in the U.S. for about 3 years. We've really changed that a couple years ago, and now those products are close to market. Our first one, we're going to show everyone in Kentucky the platform. We're going very low end, super affordable EVs for urban duty cycles and for commercial. Our E-Transit have been very successful with people who have scheduled routes. They don't have to worry about public charging on the fly. That's where we're seeing traction with our EV business. The real low end for people who just want a commuter vehicle that's really cheap to operate, and an EV is cheaper than ICE, and commercial. We're not going to invest in a lot of the very expensive crossovers for pure EV. We think that's going to be a hybrid business.
What does the supply chain look like specifically for the EV and hybrid business right now? Are some of the kinks that we saw last year and at the start of this year, has that been worked out?
It has. We're really excited about our new affordable battery. We have a plant in Marshall, Michigan that's going to be one of the first to make in the U.S. a LFP battery. That battery supply chain has really reacted to this change in the market. We're looking to repurpose our unused battery plant assets, and more to come on that. I think the supply chain has been very difficult because the demand is so much lower than everyone thought. The growth has been there, but lower than everyone thought, and we've all adjusted to that. We've moved out our cycle plans. We've focused on affordable and commercial. A lot of people are fully pregnant with a lot of OEMs are fully pregnant with their existing lineup of these very expensive EVs. We're fortunate we moved 3 or 4 years ago, and we could tilt to hybrid and a specific kind of EV, and the supply chain has been able to move with us so far.
I want to ask, first of all, I'm excited when you come out with a 3-row E-Rev, call me up, because I'm in the market for one of those. I want to ask about the unintended consequences of this administration's tariffs, Jim, because the Japanese or the Europeans, maybe the South Koreans, they're getting away with a 15% flat tariff now, but you and other American automakers producing here have 50% tariffs on steel, 50% on aluminum, 25% on foreign parts, up to 80% stacked tariffs on Chinese parts. To the extent that it's got to really disadvantage you when you're competing against a Toyota built in Japan or a General Motors vehicle built in South Korea. Can you quantify that disadvantage?
Yeah, I mean, we studied it very carefully. If you look at labor, if you look at the material costs, as you mentioned, Matt, and you look at the currency, a lot of these countries have currencies that really advantage their export. We think it's $5,000 on, like, say, a RAV4 versus a Kentucky-built Escape, and maybe as much as $10,000 on a Japanese-built 4Runner or a Subaru versus, a Bronco built here in Michigan. So it's really meaningful. What we're working with the administration is to take that layered tariff, because the autos have their own tariff, plus they're subject to all these other tariffs. We're working with Commerce and the Trump administration to minimize our tariff expense so that we can get more competitive. But the bottom line is our plan at Ford is not to compete in those commodity segments. We're really passion products like Bronco and Mustang, work vehicles like Super Duty and our trucks, and breakthrough EVs, which everyone will learn about in Kentucky in a little bit. That's where our capital's going. So although it's a $5,000 to $6,000, disadvantage, our capital really isn't going into those segments.
I get that, and I feel like, some Americans are willing to pay more to support a $70 an hour labor cost that we have here versus, a $20 to $25 labor cost that the Japanese are working with. But it still seems, like General Motors could move more production to South Korea if they get a 15% flat rate and have a huge advantage over you. They're the biggest auto importer in America. Have you talked to the Trump administration about working this out somehow?
Every day, every week, every month, every year, we have daily conversations with our counterparts in government, and whether it's emissions, whether it's tax policy, but especially tariff policy, they are very committed to minimizing this disadvantage that we have, making 80% of our vehicles in the U.S. But, a lot of those vehicles that we make in the U.S., you can't really find a way to make those vehicles outside the U.S. And just remember, there is a chicken tax that's been around for a long time on heavy trucks that would be very difficult, impossible to be competitive overseas. That really affects the commodity segments like RAV4 and others. But that's not our strategy at Ford to go after those segments. I'm very hopeful that the Trump administration understands the predicament that we are in as they make these bilateral trade agreements, and they are going to work with us to do the right thing for our U.S. manufacturing companies.
So, Jim, the president is actually speaking now at an event in Washington on healthcare technology, but he's making a lot of comments about bringing U.S. manufacturing back here in the U.S. He specifically says for factories for AI and cars, that he wants all that, of course, to be built here in the U.S., a reiteration of comments we've heard in the past. Based on the policies that at least have been proposed and whatever policies have started to be rolled out, are you seeing any sort of material progress in bringing more auto manufacturing back to the U.S.? And I don't mean just cars, but also parts too.
Yeah, we've been watching really carefully our competitors' announcements in auto and our suppliers' announcements of what's getting reshored. The reality is that a 15% tariff for finished vehicles, that is not a high enough tariff. It'd have to be more like 30 to 40% to build a new factory in the U.S. Now, we've seen a lot of our competitors, even our domestic competitors, fill open factories here where they have bridge production. They may make it in Mexico and the U.S., the same nameplate, and they are moving some of that back to the U.S., which is good for our country and good for our manufacturing. The key thing is going to be the accumulation of effect of emissions policy, tax policy, as well as this tariff policy. We have to work out a solution for this tariff policy as the Trump administration works through those bilateral trade agreements. And as I said, The conversations so far have been very productive, and we'll let everyone know when we make material progress.
All right, we'll let you get back to work, Jim. Appreciate you taking time for us on a really busy day. Jim Farley, the president and CEO of Ford, and our thanks to Matt Miller, the co-host of Open Interest, right here on Bloomberg Television. A focus on new cars, but we should also point out used cars are still hot, at least based on the results that we just got out of Carvana. Those shares up 16% in the after-hours trade, a 42% jump in revenue in the most recent quarter. Profitability, $1.28 on the bottom line, and the company guiding higher for the full year, saying it sees adjusted EBITDA in a range of $2 to $2.2 billion. All right, we do want to stay in the transportation space and take a look at the European plane maker Airbus, the world's largest plane maker. It reported second quarter earnings earlier today, and the big concern was the big cash burn. I had a chance to catch up with the CEO of Airbus earlier today, Guillaume Faury. Here's what he had to say.
What we see in the first half of the year is a number of delivery that is at 306. But we have also to have in mind that we have 60 aircraft sitting on the ground, fully finished, but with engines missing. We call them gliders. So if you look at what we've been able to produce, including the gliders, actually we are mostly on track with what we expected to do in the first half. So we count on engine makers, namely CFM and to a smaller extent Pratt, to recover on their engine deliveries to Airbus, so we can be back on track with a number of deliveries. So actually, the negative free cash flow that we have recorded for the first half reflects mainly those missing deliveries and engine missing, leading to aircraft on the ground. Overall, we have confirmed our guidance because we believe we will get those engines and we'll be back to where we need to be.
Are the delays in getting those engines, is that related to labor issues, or is that more for parts and just some holdups in the supply chain?
Well, that's more the latter. Actually, these are more short-term issues that were generated in the first half of the year. When we look at the CFM situation, GE faced industrial difficulties in the beginning of the year. They delivered their cores, the hot section of the engines, late to the other partner, which is Safran. And then Safran faced a strike, a 7-week strike that impacted very significantly their ability to deliver on time. They are recovering now, so it's really a timing issue facing industrial challenges. And we believe they are in the situation now to deliver us back to normality till the end of this year. So that's the outlook for the next part of the year.
With regards to the backlog of orders, I am curious as to what adjustments, if any, you have had to make in light of some of the lower demand coming out of the U.S., the restructuring of the order book over at Wizz, as well as a few other customers that, at least for right now, might be on the sidelines.
Actually, what we face at Airbus is a very high level of demand overall. We have by far more demand than the ability to supply. We have a very strong backlog, the biggest backlog in the industry, and this backlog keeps going up, keeps growing. So we are not looking at it as a risk for our business moving forward. The overall global demand keeps growing, and we are doing our very best to ramp up to serve that demand.
How linear is that? And more importantly, Guillaume, there's a big question here about whether some of your customers are actually asking for an acceleration in delivery of their order book.
Well, actually, most of them, if not all of them, are asking for an acceleration in the delivery. As I said earlier, we are held back by the availability of engines. We are ramping up on the A320 family, which is the bulk of what we do, up to a production rate, a monthly production rate of 75 aircraft a month by 2027. That will be the highest ever achieved for a commercial aircraft. So that's the challenge we have in front of us. It's a good challenge because it reflects the strong demand we have for our products.
You gave guidance for investors here that explicitly did not take into account the framework of a deal between the United States and the European Union. When do you think you'll have a little bit more confidence of factoring in that trade deal into your guidance?
Well, that's an important question to us. We had the news over the weekend of the agreement and the fact that civil aviation will be back to the so-called 040, meaning no tariffs. That's something we have enjoyed since 1979 and drives the success of this industry. We need something papered out and implemented. We need an agreement in force as soon as possible to be able to be back to normal operations. That's something important to us. But we welcome the agreement. We hope it's going to be in force as soon as possible, and ideally more a matter of weeks than a matter of months.
Guillaume Faury there, the CEO of the world's largest plane maker, Airbus. They reported earnings a little bit earlier in the day. The shares over there in France fell slightly in the cash session, and their ADRs here in the U.S. A little bit more than that. We do want to turn our attention back to big tech with those big results out of Microsoft and Meta. Meta really seems to be the star of the show, up about 9% right now as it spends more money. Mandeep Singh joining us right now, global head of technology research at Bloomberg Intelligence. You know, when I spend more money, I just get a reprimand from my wife. But when Meta does it, apparently they get, well, you know, another even higher valuation than what they have. In all seriousness, they're spending a ton, tens of billions of dollars in CapEx on AI. Where exactly is that money going?
Well, it shows up in the numbers for this quarter. They had a really big beat on the top line and operating income line as well. And it was powered to an extent by their better ad targeting relative to peers. It shows up in the ad pricing. But they're guiding to another year of almost 50% increase in CapEx. So that takes you, they haven't given the guide explicitly, but they say similar growth. So that takes the CapEx number for next year to over 100 billion. Wow. Now, when that happens, clearly, you know, the stakes are getting higher. But look, they've been executing very well.
Let's use some of these numbers. So you have them beating on free cash flow, but from the almost 11 billion they had in free cash flow in the same quarter a year ago, it's down to 8.5. I'm wondering how much cushion there really is. If they're going to be spending more, at what point are you looking at that number dwindle and start to get worried about it?
Well, I would say they are under-earning on EPS and free cash flow by almost 20% because of the Reality Lab losses. We're talking about $20 billion in Reality Lab losses that they could easily move over and say, okay, we're paring back. So that is the beauty of this business model. Incremental margins on their ad sales are close to 90%. And when you have that sort of a business that's powering, you know, Reality Labs and the data center spend, they can do it at their scale.
Yeah, just real quickly, do you think they're actually going to abandon the idea of an open source strategy to AI? I mean, completely abandon it.
I mean, Mark Zuckerberg's vision has been to create an ecosystem where their model is standardized and used by a partner ecosystem. I think they will keep trying at least for 12, 24 months. If that doesn't work out, the other option is to maybe start using Anthropic, license Anthropic. Who knows? I mean, they're investing a lot. They want to build their own model. But then the fallback option is use another frontier model like an Anthropic.
It's not easy to let go of a dream, Romain. It's not easy. Mandeep, we thank you so very much. That is Mandeep Singh. He is Global Head of Technology Research at Bloomberg Intelligence. We are going to move from earnings to the Fed once again. The Fed's decision to hold rates was expected, but two Fed governors dissented for the first time since 1993. And the findings from tomorrow's core PCE inflation data and Friday's July jobs report could divide the committee even further. Here to discuss, Betsy Duke, former Fed governor and former Wells Fargo chair. You take a look at where market pricing is right now in the heels of that Fed decision, and this idea of a September cut is actually being less baked in now than it was a day ago. To that end, at what point do you start to worry about inflation drifting just a little higher?
Well, I'm not sure that causes you to worry about it drifting higher, because if the Fed waits longer to cut, that will tend to work against inflation drifting higher. So I think it would go in the other direction.
I do want to point out, too, where inflation swaps are being priced right now, because you do have the market betting that inflation might drift closer to that 3% level. Betsy, what's the upside risk here is what I'm asking under the surface, because there's a reason that they're not cutting
on inflation?
It. Yes.
Yeah, on inflation, it's hard to say. It's really hard to determine, first of all, how restrictive policy is. And Chairman Powell today said several times he thought it was modestly restrictive, but not overly restrictive. So since they've been where they are now, you haven't seen significant drop in the inflation numbers, nor have you seen a big increase in unemployment. So that would suggest that it's not very restrictive right now. The big unknown is tariffs. And with tariffs, you don't know how much of that cost is going to be paid by those who are importing, those who are exporting, the businesses, the retailers, or the consumers. And it is a tax increase. But if you do a tax increase, if government does a tax increase, the government chooses. This is going to be a tax on businesses. This is going to be a tax on individual taxpayers, high income, low income. The government has some control over who pays the tax. In terms of a tariff, the government doesn't really control who pays the tax.
Yeah, absolutely. And it gets to this question, why the Fed needs to move in either direction right now until we get more definitive data on whether there is an inflationary impact from the tariffs. Why not just stand pat?
So I don't see a need to move. If I were there, I would be standing pat. And frankly, I sort of do my own projections every time they do SEPs. And I would have been one of those who said that rates would probably not be decreased at all this year.
When we talk about sort of the complexion of the pressure that has been heaped on the Fed, and I know Jay Powell dodged a couple of questions on this during the press conference, one of the first things that comes to mind is this idea that when you see a dissent from Waller, is that a dissent based on conviction or is that a dissent based on a job audition? When you start to see potentially maybe a cut in rates later this year, the market would welcome that, but they're also going to question whether that's being done based on the data or based on some political pressure. Betsy, how much faith do you have in right now that the Fed truly is indeed holding the line on its independence and its ability to make decisions free from political pressure?
So I have absolute faith in the members of the FOMC to make their decisions without regard to the politics. But what happens is the optics of the politics and the current situation is that it's hard to know whether Governor Bowman or Governor Waller were dissenting because they really saw the case for lower rates and thought they should be lower, or were they dissenting because both of them had recent conversations with the White House over their nominations for Governor Bowman for the vice chair for supervision and for Waller for potentially the chairman of the Fed. And, that's really unfair to those two, but they're in tough positions. Interesting that nobody else has come out in the same place. And, I think everybody is legitimately trying to make their decisions based on their analysis of where they are in relation to the Fed's mandate.
Now, there's a lot of anxiety around those near-term potential rate cuts, but then there's also a lot of question about the longer term. The Fed chair voiced uncertainty today around the neutral rate and the disagreement there. Where do you think the neutral rate stands, and do you think that there's a chance that the Fed could get there by the end of 2026?
So I think that the neutral rate is somewhere closer to 4 than to 3. I would say somewhere between 3.5 and 4. So I don't think the current rate is all that restrictive. There are some, if you look at the last SEP, there are some that think the neutral rate is 3 or even lower than that. And that's always been something that has been where the members of the committee have had different ideas as to where the actual neutral rate is. Back in the Greenspan era, when they first started talking about the neutral rate, it was considered to be somewhere a little above or below 4%. Then during the financial crisis, there was an expectation that R-star, or the estimation that underlies the neutral rate, had gotten much lower, had come down much lower for various reasons. And so I don't think anybody knows right now where the neutral rate is. But if you combine a concern about inflation with a belief that the current rate is not that far off of neutral, that leads you to a position of not lowering rates.
All right, Betsy, always great to talk to you. Up against a break here. Betsy Duke is a former Fed governor and former Wells Fargo chair. They're helping us to break down not only what we learned, Shonali, out of the Fed earlier today, but this idea that all of these economic data points over the next few days, weeks, and months are really going to be critical in shaping what comes next.
Big time. You look at jobs coming up, PCE just tomorrow, and everybody hanging on every data point because the market is essentially split on that potential for a September cut.
Yeah, it'll be interesting too. I mean, we take a look at the after-hour trade here. You're not seeing a huge pop in futures on an aggregate basis. The S&P futures only up about 10 to 0.2%, but they are getting some help there, as you can see in the middle of your screen, from Meta and Microsoft.
Looks pretty for the AI crowd, doesn't it? You have Meta beating, you have them guiding towards them, potentially spending more money next year, investors absorbing that CapEx spend comfortably, and Microsoft giving you a look under the hood of that Azure money.
Absolutely, and we should point out that the gains that we're seeing in Microsoft, that's actually boosting some of the other folks in the hyperscaler space, including Amazon. Those shares up 2% here in the after-hours trade as we push ahead to tomorrow and what the markets will have their eyes on over the next 24 hours. That includes another rate decision, this time in Japan, but really the star of the show tomorrow is going to be more earnings, Shonali, before the market, a whole slew of names.
I'm actually interested in not only CVS because of all the worries around health insurance and health costs, but also MasterCard after Visa's report today. Health of the consumer, people watching closely. Shake Shack might give you a little bit of that too.
Ah, yeah.
Maybe.
Everyone loves a good Shake Shack. And then after the bell, you're going to get Apple, Amazon, which we were just mentioning here. So rounding out the Mag 7 there. Coinbase, that could be interesting.
Especially after you saw Robinhood really outperform today. Of course, these two are becoming in greater competition.
And as Betsy was just talking about, we do get the monthly PCE data tomorrow, as well as those weekly jobless claims numbers. Hey, thanks for being here today, Shonali.
My
you go
pleasure.
wire to wire, host of Open Interest in the morning, and here you are on the close.
Tomorrow, catch us in the trade.
All right, and stick around for all your politics coverage. Balance of Power is coming up next, right here on Bloomberg.